Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. As always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. Don't forget to share this around with your friends and all of the great stuff. But we have another great episode with another great guest. I love guests like this. Someone who has 40 years on Wall Street in the industry, UBS, some of the biggest firms in the world that we have. So if you're catching this live, comment and tell me where you're catching this live from. So again, if you're catching this live, tell me where you're catching this live from. But back to what I was saying, 40 years into the industry, and then also not only having 40 years into the industry, starting his own registered investment advisory, starting his own firm, and then, within 1 year, he told me before we start the show, 400 million up under management with the family business. So what we're going to talk about today. So I know people are going to say, Prince, what are we going to say? We're going to talk about this. The first thing that he said that I love that he said was, why do most family businesses fail? So we're going to talk about why most family businesses fail. Business perpetuity, meaning that once you start that business, how do you keep that business going? Right, and how his firm helps clients with that. Also, investment strategies, building investment strategies that connect with your personality. And most importantly, we're going to be talking about current events too. Everybody has all this equity. I get so many emails and comments saying, hey, I got this equity in my house or whatever. What should I do with it? But without further ado, ladies and gentlemen, before we get into it, we know already. Let's bring in my guest, the CEO of Interchange Capital Partners, Mr. Ahmie Baum. Y'all give him a nice round of applause.
All right. Thanks, Prince.
Ahmie, how's it going today? How you doing today?
My day's going great. It's a pleasure to be on your show, and thank you for having me.
Awesome. It's definitely great to have you. I look up to people like you as inspiration. 40 years in the industry, that's so much knowledge, starting your own firm. So I always want to get wisdom from, I'm younger, I'm 36 years old. And
there's only 30 years between us. That's
only 30 years, but I like to get that knowledge from a different generation, see what they're saying, because they come from a different generation. You cut from a different cloth. Coming from Wall Street, the biggest banks, doing it at the highest level of finance. I definitely want to see what you have today live for the audience. But something that struck me, as you already know earlier, you talked about this, businesses. I want to get into this first question. Why do most family businesses fail? Because we all want a family business. Why do they fail?
Yeah, it's a great question. And that's the area that we specialize in. Family businesses and businesses in general. There's a lot of wealth that gets tied there. And, when people ask, how can I build the most wealth? We know that you have two choices. You can be the employer or the employee. And generally, you want to own. You want to be the employer. So most of the wealth in this country is in the hands of business owners. But we also know that most businesses don't make it past the second generation, let alone the third generation. And so there's definite reasons why most businesses fail. And one of the number one reasons is they don't have the right people on the bus. That comes from a book called Good to Great. And, if you have to be spending all your time managing your people instead of your people managing themselves, then you don't have the right people on a bus. And the other reason why most businesses fail is they have really ineffective management teams. Too often people get put into management because they're successful at something else, but they may not know how to manage. And so we've got ineffective management teams. The other issue that happens a lot with family businesses is they don't have the expertise to deal with inevitable family conflict. Now, let's face it, all families have dysfunction. You add a business into a normal family that has, so you have to know how to deal with family conflict when you're in a family business. And then the other is different generations have different visions. I have a son in the business, and I tell you, I love him dearly. He's 31 years old. He's been with me for 7 years. We have different visions of the world. I've been there, as one of my friends told me, he says, you've been where they have, they've never been where you have. And that kind of tension between the generations is a challenge. And yet you have to respect that younger generation. I talk to people, the baby boomers, which I am, and I can't tell you how much nonsense I hear about the younger generation. Oh, they don't want to work. Oh, they don't want to do this. And I keep reminding them, do you remember what our parents used to say about us? I mean, that's just nonsense. Some of the greatest people I know are the young millennials, the Gen X's. This is something that, I've run into people, and they are just willing and able and driven. And so you have to remember that every generation, and you got to find those strengths. Then the family has strengths, and the family sometimes doesn't recognize. Too often the things we know the best, we tend to dismiss. We don't think it's really that important. Oh, we're not that different, but it's really important to use family strengths, and a lot of families don't do that. One of the big things around why family businesses fail is the way they handle their advisors. Most of them, everyone needs an attorney, everyone needs an accountant, everybody needs all these advisors. And the typical approach to how people handle their advisors is they have these separate siloed conversations. Well, that requires you as the business owner to know about tax and legal and protection and banking and investments. Let's face it, you know how to run your business. You know how to work with your family. You know how to work with your community. So the ineffective advisory model, where it's you in the middle trying to comprehend and develop these strategies, that's very ineffective. And then the other big thing is not having a written transition plan around it. So those are the most common reasons why family businesses fail.
Okay, now you spoke on something. Family conflict. Everybody has family conflict. I have 3 older brothers. We have a mom and dad and everything like that. My first thing is, how do you resolve family conflicts? What is the problem in a business setting? How can I do that?
Yeah, it's a great question. So first of all, you have to understand that the family conflict, all those obstacles are really the raw material for future success. So it's really important to recognize that the purpose of the conflict is not that you're right and they're wrong. The conflict is there so that we can tease it out and learn from it. So it starts with respect. You have to be able to look at somebody who you're in business with or who's in your family and have some basic respect that they know what they're talking about, or they believe something very strongly. I mean, let's face it, we're living in a world right now where, there's so much conflict, but it starts with, I respect the fact you have an opinion. Let me understand it first. Too often when we listen, we don't listen to understand. We listen to reply. So these kinds of skills, to listen first, understand, recognize that the people who you have this conflict with, they have some legitimate things to bring to the table. And so if you come to it with an open mind, an open heart, and you say, look, we're in this together because we want to build something special, whether it's a family, whether it's a business, whether it's a relationship, then you start with understanding, you start with an open mind, and you listen for that rather than trying to get your point across so that you can be right or you can be the smartest person in the room. Those are some of the strategies that we use. There's other ones that you go into much greater detail, where you have family governance, you have family councils, you have all kinds of other things, so that when conflict arises, you have ways to deal with it. And then you set up parameters so to try to avoid some of those, so that they understand the decision-making process and they're part of the decision-making process. Well, you can cut off the conflict before it even starts if you set the proper foundation.
Okay. Well, I got to ask you this question. It's common sense to understand the difference between a family business and a non-family business,
Right.
which one usually has the most success? A non-family business or a family business?
It really isn't broken down that way.
Mm,
There are great family businesses,
mm-hmm,
and there are great non-family businesses. It's really about the difference is what I said before: getting the right people on the bus, having a strong management team, being able to deal with conflict because conflict happens in all businesses,
mm-hmm.
having written plans around making sure that the different views and visions are there. So there's all kinds of, I don't think you can categorize that one type of business is going to be more successful than the other. I think what you can say is what makes up, if you have a business where everybody in the business is working in what Dan Sullivan from Strategic Coach calls unique ability, that they're
Mm.
doing what they love to do, and you empower them to do what they love to do, and you're solving a problem by creating significant value, by helping your customers eliminate their dangers and capture their opportunities, you're going to have a successful business.
Got it. Okay. Now I want to switch gears here for a second before we come
Sure.
back to the business owners. Let's go on what's happening today. There are a lot of young people here who's brought their first home or their second home. And as we know, we have a hot real estate market right now. So
Very
meaning
hard.
a lot of people have a lot of equity.
Right.
Some people saying, hey, I have 50,000, 100,000, 200, 300, $500,000 in equity. What should I do with it? I don't want to buy another house. What are some things I can do with my equity? What do you got to say about that, Ahmie?
Well, I would say first and foremost, that's the wrong question to ask. Just because you have
Mm-hmm.
equity doesn't mean you should go do something with it. Because if you do something with your equity, it's going to cost you some money. You just not, you can't take your equity out of the house unless you're going to sell it. So if you sell it and you say, okay, I've got $500,000 worth of equity, so I bought this house for $300,000, and now I'm in one of these hot markets, and I can sell it for $800,000, and that's great. But where are you going to find another house for $300,000? It's just the value of the. So part of what we say is once you put money in those walls, you rarely get the money out of the walls for free. You're not going to. So you have to realize that if you take money out through a home equity, which through usually a home equity loan, there's a cost to it. So the first step is you have to go back and cash flow your life. And I think that's something that most people in the investment world do not talk to their clients about. It's about recognizing that everything has to cash flow. When you talk to a business owner doesn't make a decision unless they know they can cash flow their life. They cash flow the project first. If it doesn't cash flow, it never sees the light of day. So when you go out there and say, I've got all this equity, well, that's great. What's it going to cost me to get the equity out? And can I afford with my current income to support that? Now, if you're going to take that equity and you're going to turn it into another income producing vehicle, and you're comfortable that that income producing vehicle can return more than your cost of equity, well, now you've got a winning formula. But I think people don't recognize that first step. You got to cash flow your life. Too often people have gotten into trouble because they go out there, they get their home equity, and then they borrow it and they go put it in the stock market, and then the stock market crashes, and then they're stuck. I know the stock market's only been on a one-way street since 2009, but I've been in the business for 42 years. I've seen plenty of bear markets, with it. So I would not recommend that people take their home equity and go invest it in stocks or cryptocurrencies or anything else that has that risk. Now, if you want to take your home equity and go buy a rental property and start building something, or if you want to go out and take your equity and put it into some dividend income, or use it for a business, but understand it comes at a cost. And as soon as you do it, you're increasing your risk. And you have to be comfortable that you understand the risk before you go ahead and do it.
Okay. Now I got you use very prominent word there. You said cash flow your life. What is cash flow in my life? What do you mean by that?
What I mean is very basic. You know how much income is coming in, and you know how much is going out.
Mm.
And you have to be looking at that. And too many people, we know this, too many people live to their paycheck or beyond. And that's why there's so much debt that people are carrying. And that's the killer. So if you want to create significant wealth, you have to follow a basic principle that my father taught me years and years ago. For every dollar you make, 10% gets put away before you even begin to think about spending it. So you start building your savings with it. So cash flowing your life at the simplest level is knowing how much income's coming in versus how much you're spending. And at the end of the month, you've got some left over. Now that's at the simple level. When you start to look and start to project forward, which is what we do, because a lot of times we're dealing with people who are saying, I have built up so much, I have to make sure that I'm no longer working, I'm retiring, and I'm thinking about that. Cash flowing their lives now means they have to take all their assets, create an income off of those assets so that, and we use age 99, so we stress it for a long period of time, so that there's enough money around so that when you're 99 years of age, you could still do your life. Now, when you cash flow, you have to add in taxes. You have to add in inflation because things cost more and more every year. And, Uncle Sam wants his share.
Okay. Now to the person that's saying, hey, you know what? You're right. You spoke about in your 42 years, you've watched, so many bear markets and bull markets, and we've been on a one-way street since 2009. Some people out there are saying, hey, the real estate market and the stock market is so hot right now. Do I buy? Do I wait? Do I hold on to cash? What do I do?
First of all, if you have a long-term focus, meaning measured in decades, you could buy whatever you want today in stocks and real estate. I have a theory about real estate right now. In 1950s, the baby boomers, which I am, there was a huge, I was the product of the baby boom generation. And my parents, there was a huge upward movement in real estate when baby boomers turned of age. We started buying homes when we were in our early 20s. And that lasted, because we're such a large group, that lasted for a long time, and prices went up and et cetera. Now, I think what's happening is we're at the beginning stages of the millennials. Now, the millennials are a larger group than the baby boomers demographically, and they just waited longer. So these millennials are now in their late 20s and 30s, and they're finally, a lot of them have had dual incomes. They were able to save. Now they are saying, we want to own homes. I think COVID-19, frankly, was part of that.
I want to ask a question. So you said the baby boomers didn't buy houses this early as the millennials are.
No, just the opposite. Baby boomers bought it earlier because we were taught by our parents that was the first thing you wanted to do, was get your house. Buy a house. That's the very first thing you did. Millennials took their time. They said, what do I want a house? It's too much. I don't want to do it. And with it. And frankly, the values of homes and real estate weren't growing as much for the millennials as they did for the baby boomers. So I think
it was a hotter market for the baby boomers.
Yeah, back then. I think we're at the beginning stages of what's going to be a continued hot market in real estate. I don't think we're going to. And in terms of the stock market, the stock market's high, but when you relate it to interest rates and inflation, when you have low interest rates, you can afford to have higher price earnings ratios on companies. Okay. And so therefore, it's a competition for money. Where are you going to put your money today? You can put it with the banks and you can buy, but you're going to get less than 1%. Or you can put it in equities, and not the crazy numbers that we've been seeing, but the average return on equities have been somewhere between 7 and 8, 9, 10% over time. Where are you going to be best treated? Where's your money going to be best treated? So I think the stock market has plenty of room to continue to grow. I'll bet not as much as it has over the last period of time. I think it will slow down. I think there's some areas in the world that are less expensive. I think international equities are much cheaper. Historically, they haven't been this cheap in 20 years. So the key to stock market investing is, first of all, you have to have time. Secondly, you must be diversified. So it's different. I know everybody wants to find the next Amazon, the next Apple. I get that, but that's the risk side of your equation. And there's room in your portfolio for a risk, but you have to have your base. You need your strong, solid base. And then from there, as you get your base and you build up, then there's a point where if you want to take 10% of your liquid investable net worth and take greater risk with it, you can do that. But I think the real estate market and the stock market still have some room to run.
Okay. Now, I want to answer this question with people, the young millennials, I feel it's accessibility. You could let me know if I'm wrong on this because you actually lived in this time. I read about this time, but looking at this time. So now you're looking at accessibility to the market has increased so much now. People have phones and people, pretty much anybody can invest. Do you think it even makes sense to have a wealth manager?
Yeah, I do, because I think what's going on is not investing. It's not investing. What wealth management is wealth management is more than just investing. Wealth management, as we define it, is investment, it's planning, and it's relationship management. So investment management is different than when just opening up a Robinhood account and buying the latest meme stock. And I know I've had conversations with my clients, and my son, he bought AMC and he made all this money. I says, I'm happy that he's getting interested or she's getting interested, but I don't like the trend because it's speculating. What you want to do if you want to build wealth over time is you need to have a plan. Now, if you're comfortable, you can certainly, there's plenty of do-it-yourselfers, there's plenty of books you can read, then maybe you don't need a wealth manager. But if you're struggling to figure this all out and you don't have your emergency reserve, which is 6 months to 12 months worth of living expenses put somewhere that's safe and secure, then you shouldn't be investing. And if you don't recognize what diversification is about, if you don't recognize that wealth gets created over time, not the quick hits. These quick hits, what they don't recognize is they're also taxed at the highest rate. And so part of planning and part of what you have to deal with when you're involved in wealth management or investment management is tax mitigation. Tax mitigation, you have better tax treatment the longer you hold an investment, and you get better returns the longer you hold it. When I first started, I'll never forget this. When I first started this business 42 years ago, I met a woman, and I think she was at best back then, she might have made $30,000 a year. Now you understand, this was 1979, okay? 1979, 1980. So I don't know what the inflation numbers are, but 30. And I looked at her portfolio and she had $2 million. I said, how did someone with $30,000? She said, all I did is I saved my money. I don't remember what the percentage was. It was 10 or 15 or 20. And I bought stocks, good quality companies. I reinvested the dividends and I forgot all about it. Now, if you can do that, you don't need a wealth manager. But most people can't do that. Most people, you need the wealth manager when the world has gone crazy and the bear market show up and everyone's losing their head and you have to stay calm in the middle of the storm. That's what you need wealth managers for. We can show it's really behavioral coaching to help people not buy at the tops and sell at the bottoms. The old adage is, how do you make money? You make money buying low and sell high, but nobody can do that because to buy low, when you look out into the world, everything looks terrible. To sell high, what are you telling me? I'm making all this money. I can't possibly sell high. So it's the nature of who we are as human beings makes
Mm.
it difficult to be successful at this. And that's where having a financial advisor working with you to help you build the plan first. Because you really need to start with, even before you go investing, you really need to start with protection. Because the most likely scenario, unfortunately, is death and disability. You're most likely to get disabled. So you need to take your money and build the protection, the safety net first. Then once you've built a strong enough safety net, then you can start investing. And if you're a millennial, you have plenty of time.
Mm.
Plenty of time to do it.
Now I got to go to this question. We got to go get back to it. I want to get some lessons as a CEO. So, you've been on Wall Street in the financial industry 40 years at the top of the game, UPS, Wall Street, all the good stuff like that. Then you went off and started Interchangeable Capitals and have over 400 million under management. I know we're talking backstage and you said, hey, yeah, it sounds like that it was 1 year, but it really was 40 years because you built your clientele. So what lessons do you have as a CEO going from working at 9 to 5, being the executive to now being the CEO? What lessons you took? Let's get some of these CEO lessons from you.
Well, I think the most important thing that a CEO has to do is create the vision. You have to be the one who holds the vision of where you want your company to be. And then once you have that vision, then what you have to do is empower your people. You have to recognize that you can't be the be all and end all of your business. If I just did a video called The Inconsequential Owner. We want to help people become the inconsequential CEO. In other words, if something, God forbid, should happen to me, Interchange Capital Partners will live a long, healthy, prosperous life. But if I'm at the middle of everything and I'm controlling everything and I'm doing everything and something happens to me, Interchange Capital is in real problems. So the lessons to be learned is have the vision. You have to be the vision. You have to be the cheerleader. You have to be able to help and then empower your people so that they can grow and develop and become the next generation of that. So certainly you have to keep people accountable, but if you have the right people on the bus who are passionate about what they do. So Interchange Capital Partners, we're all about that concept that I mentioned to you earlier from Dan Sullivan at Strategic Coach called unique ability. I want people to be working 80% of their time in their unique ability. So what's unique ability? It's not what you're good at. It's not even what you're excellent at. It's what you're passionate about. It's what you love to do. It's when you get up in the morning, it's the first thing you want to do. It's when you get into work, it's the first thing you want to do. So you can always look and see by what activities drive you that you want to do, that you get done very quickly, that you never procrastinate on, that when you finish that work, you're more energized and excited than when you started. That's passion. That's unique ability. So if you can have an organization that has the vision and then fill the right people on the bus with unique ability, and then once again, remember, solving problems for your customers and always creating value for them, helping them eliminate their dangers, helping them capture their opportunities through your intellectual capital, then you're creating significant value. People will pay for that. And you can build a very, very successful business.
Okay. Now, speaking of yourself, I know you're probably, you already said you got 42 years of experience, and I know you started when you were 10 years old, so you're only 52 years old. Now I got to ask you this question. How are you setting up your business perpetuity? Keeping your business running past you. How are you doing this?
Basically the same storyline. First of all, I brought in younger
Your
people.
son.
I brought my son, my team, my management team, and I'm 66, so I started when I was 24. I'm 66, and there's the next oldest person is 34. So
Mm.
we have a gap, and we're trying to, we need to find somebody in between the 34 and 66. But frankly, if something happened to me, I have enough confidence in my team and the people in my organization that they are capable to take Interchange Capital because we've set the vision and we've got the right people on the bus. I hope that I can live until
Okay.
90 and keep doing this because I love what I do. I'm passionate about it. I would do it for free if nobody paid me, which is another example of passion. Fortunately, they pay me, which is wonderful, you
Mhm.
know. But keeping a business in perpetuity is really about legacy. And I want to have Interchange Capital. We started Interchange Capital in the middle of a pandemic. And I said, I want to see in 100 years from now that people will say, yeah, Interchange Capital was started in the middle of a pandemic. That's a vision. So I have to have that vision, and then I have to make sure that we have core values and core purpose, and that we have buy-in from that, and we're constantly going back to the marketplace. And there's a simple metric that you can see whether you've got something that will work. You
Okay.
talk to all your friends, you can talk to everybody you want. Will the marketplace write you a check for what you want, for what you're offering? And if they write you a check, you know you got the right solution out there. So you want to sell your thinking, and you want to be able to go out there and solve problems, help people reduce their dangers and fears, and help them capture their opportunities.
Okay, well, that's pretty good when you said that about interchangeable capital partners, about being able to live that. You have the right people on the bus to keep you going way past. I know you say you got a little problem with 34 to 62, so I don't know. Are you looking for like financial people or just people to do,
Well,
just good people in general?
Well, we have a business plan of what we're looking for. We want to
Hmm.
continue. Our target market are the baby boomer business owner who has, like me, who frankly maybe has lost the passion, who wants to take some chips off the table because most business owners have all their equity not in the market. They have their equity in their businesses, and it's not liquid. So
Hmm.
they're looking for how are they going to be able to create the liquidity, and we assist them in that. So what we're looking to do is find those business owners, and in that process, we're going to need more strategists, more analysts, more
Yeah.
relationship managers, et cetera, as the number of family businesses come to that recognition that they really need to have a written plan, an action plan around the largest financial transaction of their lives. And if they get it wrong, unfortunately, it has generational consequences. So, we want to help them get it right. So we have a strong growth strategy. And as the business grows, we know exactly where we're going to need to hire with that. And
Okay.
we,
Now I gotta ask you this question, right? Investment strategies that connect to people's personalities. How do you take someone who's a business owner and find out what their personality is and connect that to their investments, or even just a regular person that's tuning in that's like, hey, I'm into investing. How do you get that? How do you connect it? The
well,
two?
I mean, again, it starts with listening and understanding. You have to find out who you are. What's your goal? What are you trying to accomplish? There are some people that are gunslingers. They're risk takers,
Mm,
right? And therefore, the investment strategy of buying and reinvesting dividends and taking your time isn't going to fit with them.
mm,
They want the quick hit, but they have to understand that the quick hit also means there's going to be a lot of losses. It's like the great home run hitters have struck out the most with it. So in terms of connecting, first of all, you have to know yourself. You have to understand what you're trying to accomplish. Wealth traditionally is created over time. And that's part of the problem I have with the Robin Hoods of the world. Not that I want it to be democratized. I want people to have access. That's not what I'm saying. What I'm saying is there's a gambling culture, that there's a get rich quick culture. Okay. And when you look at that, that has more disasters to it than those. Now, your personality can still be a risk taker. You can still have a risk taking. So let's go back to your previous question about home equity. So if my personality is I'm a risk taker, I'm only to take risk, and I've got a couple $100,000 in equity, and I got this business idea. So I take my $200,000 and I start my business. That's a risk personality. I have somebody who's not who's risk adverse, then I would say you'd never take that money out of there. Or you would take some of the money out and you'd buy a dividend paying whole life insurance policy, which could never go down, only goes up. So being able to connect personality is really two sides to that. You have to know yourself as an investor. Too often, there's a great story about a client that I ended up with. And I asked him, so how much, he was a business owner. So how much can you afford to lose? He said, I can afford to lose 20%. I said, okay. So we created this investment strategy around that. And the market was down 10% and he's going crazy. He's calling, tell Ahmie, get his butt down here, get his, I said, Vince, what's going on? He says, market's down 10%. I said, Vince, we had this conversation. You said to me that you could live with a 20% decline. And he had this sheepish little grin on his face. And he turned to me and said, I lied. He was right. He lied. He says, I thought I could live with 20% decline, but frankly, I can't. And at 10%, I got panicked. So first rule, know yourself. Who are you as an investor? And then make sure you have an advisor around you who can match that up.
I like that. Well, Ahmie, it's definitely next time I'm in Pittsburgh, I'll try to check you out. I need to come out there and check you out one of these days.
For sure.
Definitely, I'm in the area. I would definitely love to have you back on. And before that, is there anything you want to say to the live audience and to people that's going to catch the playback?
Well, I would say to you, since our target market of people who we were looking for, if you own a business and you are successful at that, I will tell you that it's, and I don't know if you're a motorcycle rider or not. I used to be. A motorcycle, people who drive motorcycles know it's not if you're going to get into an accident, it's when. It's inevitable. So I want a message to your business owner fans who are out there building successful businesses, that it's not if you're going to have a liquidity event, it's when. You don't know how long you're going to live. You don't know if you're going to be able. So running a business for sale is just good business. So make sure that you are recognizing that the liquidity event is inevitable. If you do it right and plan for it, you're going to end up with more value for your business. You're going to pay less taxes on the sale of that business. You're going to have more cash flow available for you and your family, and you're going to be able to stay in control. So that's for your business owners. For your non-business owners, my message is the same. It's just a slight tweak. Have a plan. Don't go out without a plan. Figure it out. Look at your expenses. Look at your income. Build from safe first and then upwards.
Okay. Well, definitely thank you for your lessons and wisdom. I love hearing that, it's like hearing my dad speak.
Well, that's at 66, I get that a lot,
Yes, like your dad speak like, okay. But you need that. You need that rock in investing, because in this world, we have so much information. We got social media, we got the TV, we got the radio, we got podcasts, we got this, that, friends, everybody, all this information, magazines, newspapers, word of mouth, whatever. It's hard to stay focused, and you need that sound voice every now and then. You need that sound voice to keep you on track.
And you need the plan. You don't go out there and build a house by hiring the plumber, the roofer, and the carpenter. You first hire an architect and a general contractor to put it on paper first. You
Mm,
have, we plan our vacations with
better.
better than we plan our financial lives. So
Wow.
if you have the plan, start building the plan. The rest of it starts to fall into place.
Okay. Yeah, I see Michael out there. He's out there in Canada. He commented, he said, love this. Thanks for the knowledge, Ahmie, So definitely appreciate that, Michael, for tuning in, and all the live audiences catching this live that caught the episode live. And the playback, it'll be available on all podcasts and streams and the video as well. Well, Ahmie, I was definitely pleasant to have you on and to share with my audience. Definitely got to have you back on. And yeah, definitely. Did you have fun?
I had a blast. Thank you so much. I had a blast.
Awesome.
I had a
awesome.
blast. It was wonderful. Wonderful. Thanks for having me, and all the best of luck. And if we can help any of your listeners, we'd love to. I'm sure they can figure out how to find us at Interchange Capital Partners, and so we're here in Pittsburgh, and we work all over the country. So
awesome. All right. Well, ladies and gentlemen, until the next video, podcast, cartoon, or whatever else crazy you see me do around this globe. My name is Prince Dykes. Peace. Be safe. I'm out. And thank you.